Welcome to the Washington State Housing Finance Commission's presentation on HOTMA regulations that the Commission expects to be implemented with certification started on or after January 1, 2025. You will hear from three portfolio analysts in this presentation: myself, Tyree, and Sarah. You may be asking why HOTMA, which stands for Housing Opportunity Through Modernization Act. One of the primary aims of HOTMA is to create greater consistency among federal housing programs regarding how income and assets are counted and verified. Moreover, the Federal Office of Management and Budget, OMB, has recommended that federal housing programs modernize document requirements to reduce the burden on families accessing housing assistance. HUD has published a lot of information about HOTMA, some of which we have included and/or will be referencing in our presentation. We will also be referencing a revised Chapter 5 to our tax credit manual that is currently being finalized. Please note that some of the pages referenced in our manual may be adjusted before the chapter is published. On the HUD Multifamily HOTMA page, noted here at the top of the screen, you can find an implementation notice, which you can also access directly via the link currently at the bottom of the page. This is an extensive 129-page document with rules, definitions, and examples. We encourage you to review the full notice. There is also a link to training videos and resources. Some of the training videos were recorded last spring, and others are still to be published. Please be aware that the videos are specific to HUD, and not all aspects apply to the Low-Income Housing Tax Credit Program and/or have been adopted by the Commission. For example, the asset limitations and the requirement to verify all assets every third year do not apply. In addition, there are some unclear areas and areas where the information presented in the videos conflict with what is stated in the implementation notice. The link to the inflationary adjustments is an important one that you can also navigate to directly from the web address provided at the bottom of the screen. Here you will find the annual adjustments for items like the net family asset verification threshold, the full-time student deduction, and the passbook savings rate. Some of these will be adjusted in 2025 and some will not. The net family asset threshold will move from $50,000 to $51,600. The full-time student deduction will remain at $480, and the passbook rate will increase to 0.45%. On the HUD Exchange link provided here, you can find helpful resource sheets on assets, on income, and on student financial assistance. The income exclusion list that we will review is from the Income and Exclusion Resource Sheet. The most significant areas of change affect household composition, income inclusions and exclusions, the treatment of student financial assistance for non-Section 8 households, assets, the verification hierarchy, and then in addition, the Commission has changed some of our policies to align with the HOTMA goal to reduce the burden on families accessing housing assistance. We will be covering each of these areas during this training, pointing out changes and revised guidance in Chapter 5 of our Tax Credit Compliance Procedures Manual that is soon to be published. Please note that some of our guidance may change as HUD provides further clarification on items that are unclear, and we unravel some of the conflicting information being provided by industry trainers. The first area of change to review is household composition. This chart from the HUD 4350 should look familiar. We have updated it for HOTMA changes regarding the treatment of foster adults and foster children. Fosters are no longer considered household members for the purposes of determining income, although they can be counted when determining appropriate household size. In this manner, they are similar to limited aids and thus have been moved to the non-member section of this chart. Income of non-members, whether it is earned or unearned, should not be included in household income. We have also changed the dependent definition for the purposes of full-time student earned income exclusion. Previously, the Commission defined a dependent as someone listed as such on the tax return of the head, spouse, or co-head. We are now defining dependent for the purposes of this rule to be a household member who is not a leaseholder. We encourage owners and managers to keep this in mind when setting policies on who must be listed as a leaseholder and sign a lease. We will require a current lease copy be attached to the certification when this exclusion is used so that we may review the individual's status. Note, the 480 amount is now subject to an inflation adjustment. However, this amount will not be changing in 2025. The next area of change to review is HOTMA income inclusions and exclusions. Under HOTMA, annual income includes all amounts received from all sources by each family member 18 years or older, or the head or spouse, plus unearned income for each dependent and income from assets unless specifically excluded. This is not a major change, but it does focus on counting only those amounts actually received. We will continue to count income for household members from the time they turn 18 until the end of the certification period. HOTMA further defines some types of income and changes how or if some sources of income are counted. The rule that anything not specifically excluded should be included remains. Starting with earned income, there were no changes to employment, self-employment, or military pay. HOTMA provides definitions for day laborer, independent contractor, and seasonal worker, and it clarifies the income from each of these must be counted. Day laborer would include someone hired to complete a job that may only last one day with no agreement of more work. For example, someone who is available outside of Lowe's or Home Depot to assist with completing a home project, typically just for the day. Independent contractor includes gig workers, babysitters, landscapers, rideshare drivers, and household cleaners, who may or may not consider themselves to be self-employed. Seasonal worker has been clarified to include more than agricultural workers. It also includes those employed only during the holiday or a specific season due to the nature of the work. Anticipated seasonal work must be included if an applicant is not currently working but has a history of performing seasonal work and anticipates that they will again. When looking at unearned income, HOTMA clarifies that for child support, only the amount received should be counted. This means we can continue to use payments received over the previous 12 months to anticipate future payments when payments are irregular. We no longer need documentation that an applicant made efforts to collect court-ordered amounts to exclude amounts ordered but not received. We will continue to include arrears payments received in the previous 12 months as long as there are arrears still owing. HOTMA did not change how regular benefits from the Veterans Administration should be treated, except to clarify that lump sum payments should not be counted as income. A recent IRS revenue procedure issued after the HOTMA final rule did make changes to how these benefits should be counted. We will cover this change and the documentation necessary to exclude these benefits near the end of the presentation. One of the most significant changes HOTMA made to income is how student financial assistance is to be treated. We will review this change in detail after reviewing income exclusions. As an item of note, real property or real estate is now listed under assets with rental income, if any, counted as actual income on the asset. There were virtually no changes to how we treat Social Security benefits, spousal support and alimony, gift income, or family or friend support, unemployment, TANF or public assistance, or periodic payments from pensions, retirements, IRAs, 401ks, or annuities. Rather than concentrate on income inclusions, HOTMA concentrates on what is excluded from income, with the premise that any income not excluded should be included. Let's review the income exclusions table. This table is from the HUD Exchange, the Income Exclusion Resource Sheet, and the link for that is noted at the bottom of the page. I'm going to go through this table, adding a column out to the right in red that says whether or not this represents a real change since pre-HOTMA. The first category, Other, federally mandated income exclusions. HUD has always published a federal register with a specific list of exclusions. On January 31st, 2024, an updated version was posted at the end of the HOTMA notice. You will see some changes there because some of the items that are specifically excluded in HOTMA now have been removed from that federal register list. Assets. Imputed income from assets. So note, this is talking about excluding imputed income, and it's listing the $50,000, which will be adjusted annually, threshold, both for verifying assets that exceed over $50,000 in net family assets, and when you have to impute income from assets when there's no actual income. We will still be including actual income from assets, and Tyree is going to go over this in detail in the asset section. Non-recurring income. Income that will not be repeated in the coming year based on information provided by the family. This includes things like annual holiday, birthday gifts, or gifts for special occasions like a wedding or an anniversary. It also includes in-kind donations from a food bank. So not just food from the food bank, but if someone is getting, toiletries or other items from the food bank, that's now specifically excluded as well, as is Census Bureau pay or tax refunds. And you can get further information on this category in the HOTMA notice on page 77. Please remember that things like being a day laborer or seasonal worker, HOTMA specifically says income from those categories needs to be counted and does not fall within this non-recurring income exclusion. Self-employment, gross self-employment income. Okay, so we're still going to count self-employment as we have, counting the net amount from a business. Dependents. All earned income of all children under the age of 18, including foster children. Okay? We've always excluded earned income from minors up until the point that they're going to turn 18. We're still going to anticipate income from the time they turn 18 till the end of the certification period, And as we already discussed, we are now going to exclude any foster income. Adoption assistance, this has not changed. The 2025 amount threshold is still going to be $480, and that's going to apply to adoption assistance. It's going to apply to the earned income of dependent full-time students as far as what we're going to count, and so those aren't going to be changes. It could change, the 480 could change in future years. Students, we are going to review in detail these next two, which is Title IV HIA assistance and other student financial assistance. And we'll get to those in just a few moments. The bottom one, Student Educational Savings Account. This is a Coverdale Educational Savings Account or any qualified tuition program under IRS Section 530 or any qualified tuition program under Section 529. We've previously been excluding 529, which includes the Washington GET program. So really, this isn't going to be much of a change for us. Continuing on with our income exclusion table, at the top we have baby bonds. Baby bonds are a new concept for me. They're similar to a 529 account in some states. I haven't seen them in Washington, but to read more about it, please see the HOTMA notice on page 93. Foster children and adults. Payments for foster children and adults. As we already reviewed, fosters are no longer going to be considered household members, and we're no longer going to count their income. This includes any payments made to the family for care of the foster child, including state kinship, guardianship care payments, or tribal kinship payments. The kinship and the guardianship piece of this exclusion are new. Foster children and adults, income of foster children and adults. As we previously looked at, income of a live-in aid, foster child, or foster adult is going to be excluded. And that covers both the foster children and the live-in aid exclusion. People with disabilities. The first one, ABLE accounts, will be included in federally mandated excluded amounts. We've previously been excluding this here in Washington. It could be found in some of the HUD published changes, but it wasn't specifically called out in the 4350. People with disabilities, state payments to allow individuals with disabilities to live at home. I didn't see any change in this category or the other two categories listed here for people with disabilities. We've always excluded a plan to obtain self-sufficiency payments or reimbursements for health and medical care expenses. The last one we were previously using to exclude VA aid and attendance payments, which are now specifically called out as an exclusion. Continuing on with the income exclusion table, we have trusts at the top of this page. Trusts have always been a little confusing as far as how they are to be handled. This is going to be the same with HOTMA. The exclusion says any distributions of a trust principal are excluded, but owners must count any distributions of income from an irrevocable trust or a trust not under the control of the family as income to the family with the expectation of distributions used to pay the health and medical care expenses of a minor. So again, this is new. We must document if the distributions are from principal or earned interest of the trust. If interest, then we're going to count unless we document that it's used to pay for the health and medical expenses for a minor. Tyree is going to go through in her asset section a trust chart, and you can find it in HOTMA on page 66 as well. Next up, we have insurance. Insurance payments and settlements for personal or property loss. Insurance payments and settlements for personal or property loss, including but not limited to payments through health insurance, motor vehicle insurance, and workers' compensation. Please note that workers' compensation means labor and industries is now excluded from income, even though they're paid in periodic payments. You can find the documentation for this on HOTMA, page 80. The one question, though, that we still should ask if someone is off on workers' compensation or L&I, is there an imminent return to work where we should anticipate that income? Next up, retirement plans. Income received from any account under any IRS-recognized retirement plan. However, periodic payments are income at the time of receipt. So this is new. We're no longer going to count retirement plans as an asset. We're going to look at them on the income side only if their periodic payments are being paid. Military, hostile fire is no change. Veterans aid and attendance payments. HOTMA is now specifically calling out that this is excluded income. We have been excluding this prior under a HUD special notice. Then we have a bunch of categories about lawsuits, and these are either new or they're reworded. So the first one, lawsuit settlements. Amounts recovered in a civil action or settlement based on malpractice, negligence, and or other breach of duty claim. But this is key, resulting in a family member becoming disabled. So that's definitely a new one for us. Second one under lawsuits, reparations for persecution. Reparation payments paid by any foreign government for claims by people persecuted during the Nazi era. I believe this one has just been reworded. Tribal claim payments. Payments received by tribal members from claims relating to the mismanagement of assets held in trust by the United States. This is not per capita. Per capita, we are going to continue to treat the way we always have. The last one on the page, lawsuits related to civil rights. This one's new to me. Civil rights settlements or judgments, including settlements or judgments for back pay. There is one more page to the income exclusions table. Reimbursements at the top. Amounts received by a participant in other publicly assisted programs for or in reimbursement of expenses to allow program participation, such as special equipment, clothing, transportation, or child care. This has always been an exclusion. The same is true for the resident service stipend, the employment training programs, and the family self-sufficiency account. Any income earned on the money in that account has always been excluded. Housing gap payments. This is replacement housing gap payments to offset increased rent and utility costs to families displaced from federally subsidized housing. We've previously been excluding this under the Uniform Relocation Act, or URA. The HOTMA notice goes into more details about the gap payments and how long they may be excluded. Benefits, including deferred supplemental security income, Social Security income and benefits, or VA disability benefits. Deferred periodic amounts from Social Security or the VA have always been excluded. Property tax rebates. Refunds or rebates under state or local law for property taxes paid on a dwelling unit, and loans. The net amount distributed by a lender to a borrower or third party, for example, educational institution or a car dealership. Again, these have always been excluded. Now we're going to take a look at how HOTMA says to treat student financial assistance, or SFA. First, we need to look at some definitions. The Higher Education Act, or HEA, Section 479B, that was referenced as excluded on the exclusions chart, includes federal Pell Grants, Teach Grants, federal work-study programs, and I highlighted that because this is going to be different in how we're looking at federal work-study, which was just to exclude it. It's now going to be considered part of HEA, as are federal Perkins loans. Now, normally we would say any loans would just be outright excluded. But in this instance, because the federal Perkins loan is called out as part of HEA assistance, we'll need to look at it in that view. Also, student financial assistance received under the Bureau of Indian Education, higher education tribal grants, tribally controlled colleges or universities grant programs, employment training program under Section 134 of the Workforce Innovation and Opportunity Act. Those are all items that are considered part of HEA. If it's not part of HEA, it is considered other student financial assistance, and this can be paid to the school or directly to the student. It includes grants or scholarships received from the federal government, a state, tribe, or local government, a private foundation registered as a nonprofit, a business entity, or an institution of higher education. And again, that would be a grant or scholarship that is not included under HEA. And just a special mention, gifts from family are not considered student financial assistance, even if they're specifically for payment of student expenses. And keep in mind, if someone is receiving periodic gifts, they must be counted as income. Lastly, we want to go over what is included in actual covered costs. Under HEA, it says tuition, books, supplies, room and board, as long as it's not for the head or the spouse, and any fees required and charged to a student. This definition sounds different from what the Section 8 definition says. However, on the bottom of page 90 on the HOTMA notice, there is a clarification that, in fact, actual covered costs are the same for both programs. Now that we know the definitions that HOTMA is using under student financial assistance, let's take a look on how it will affect what we count for Section 8 households. If a household receives Section 8 assistance, either project-based or voucher, management must first determine if the student household member meets one of the existing Section 8 exemptions. The first exemption: is the student household member a dependent of the head or co-head and living with them in the tax credit unit? Or, number 2, is the student household member at least 23 years old with dependent children in the unit? If the household member meets one of the above criteria, it used to be that we excluded all student financial assistance. Now it's going to mean that we follow the HOTMA rules for non-Section 8 households. If the student household member does not meet one of the exemptions, then management must first determine the amount of student financial assistance. Then second, determine the total amount of education-related expenses, the actual covered costs the student is responsible to pay. And then number 3, count any amount of student financial assistance above and beyond the actual covered costs. So to review that in a formula mode, it is total amount of student financial assistance less actual covered costs equals the amount counted as income. This is for a household member that receives Section 8 assistance. Prior to HOTMA, we did not have to include any student financial assistance for non-Section 8 households as income. HOTMA changes this. For non-Section 8 households with student household members receiving student financial aid, management must now first determine which types of student financial aid are being received under the Higher Education Act of 1965, or HEA. If all of the aid being received is under HEA, you can actually stop at this point because it will all be excluded. If that is not the case, then we're going to go to step 2, which is determine which types of aid are not under the Higher Education Act. Once we know the split between those two amounts, then we're going to determine the total amount of education-related expenses, or the actual covered costs the student is responsible to pay for. With these amounts, we can then subtract the HEA assistance from the actual covered costs. If there are covered costs left over after subtracting the HEA assistance, then management must subtract the remaining covered costs from the non-HEA assistance. If their assistance is left over at that point, that assistance must be added to the household's gross annual income. So let's take a closer look at this. Step 1, actual covered costs. Subtract any HEA assistance. That's going to give you the remaining covered costs. We're then going to take in step 2 any non-HEA assistance and subtract those remaining covered costs. And that's the amount that would be counted as income. If there is no student financial assistance left over, then no assistance is added to the household's gross annual income. Let's take a look at a couple of quick examples. The Smith household applies for a unit at a tax credit property. They do not receive Section 8 assistance. The 19-year-old daughter, Mary, is in college and receives student financial assistance. Mary's covered educational expenses, including tuition, fees, and books, total $22,000. Mary receives the following student financial assistance. She receives a $15,000 Pell Grant, which falls under HEA, and a $5,000 private scholarship, which is a non-HEA, for a total student financial assistance of $20,000. How much of Mary's student financial assistance is counted toward the household's gross annual income? Let's follow through with the calculation steps. Step 1. Subtract the HEA assistance from covered costs. $22,000 are the covered costs, minus $15,000 Pell Grant. That equals $7,000. Then we're going to go to step 2. Subtract step 1 amount, the remaining covered costs, from the non-HEA assistance. $5,000 is that private scholarship, which is non-HEA, minus $7,000, the remaining covered costs determined in step 1. And in this case, that is a negative number, or 0. Because the total amount of student financial assistance is less than Mary's covered expenses, none of her student financial assistance is included in the household's gross annual income. In our second example, the Harley household applies for a tax credit unit. They do not receive Section 8. the 30-year-old co-head, Harold, is in college and receives student financial assistance. Harold's covered educational expenses, including tuition, fees, and books, is $18,000. Harold receives the following student financial assistance: a $15,000 Pell Grant, which is part of HEA, and a $5,000 private scholarship, which is non-HEA, for a total student financial assistance of $20,000. How much of Harold's student financial assistance is counted towards the household's gross annual income? Step 1. Subtract HEA assistance from the covered costs. So we have the $18,000 in costs less that Pell Grant is $3,000. Then we move to step 2. Subtract the step 1 amount, the remaining covered costs of $3,000, from the non-HEA assistance. The non-HEA assistance is the $5,000 private scholarship. When we take the $5,000 scholarship less the $3,000 in remaining covered costs, we come up with $2,000. Since Harold's student financial aid is more than his covered expenses, the excess $2,000 must be included in the household's gross annual income.
Analyst Tyree Gwinnett will review the changes HOTMA made to assets. As we review these changes, please prepare yourself and keep an open mind. What you have come to know about asset calculation has changed. You'll want to be aware of this as we review the changes ahead. In this section, we're going to cover the changes HOTMA made to assets, which include new exclusions to what is counted as an asset, a higher threshold to the limit of when assets need to be verified and when a household can self-certify, and when the actual income from asset is used versus when imputed income is used. With the implementation of HOTMA came a new asset limitation. This limitation restricts access to assistance if the family's net family assets exceed $100,000 or if the family owns real property that they can occupy. While this is part of HOTMA, this rule and limitation does not apply to the Low-Income Housing Tax Credit Program. Please note you may have other funding that this applies to. However, for this training, we will not discuss this topic further. One change with HOTMA is the categorization of assets as either real or personal property, with personal property being divided into two additional categories: necessary or non-necessary. Real property includes land, a house, townhome, duplex, or other forms of real estate. Personal property includes tangible items such as a boat, kayak, campers, and intangible items like bank accounts. All necessary personal property excluded from net family assets. These are excluded as they are considered essential for the family to maintain or occupy their home. They can be necessary for work, schooling, or health and wellness. They can include personal effects such as items regularly worn or used by the family. It can also include items that are convenient or useful to a reasonable existence and items that are related to a disability-related need or a reasonable accommodation. Examples of necessary personal property are cars or vehicles that are used for daily transportation or common household appliances and electronics such as TVs or video games, or wedding or engagement rings, jewelry used in religious, cultural celebration or ceremonies, or medical equipment or supplies. In addition to the reference to the HOTMA notice and the tax credit manual, these exclusions are also located within 24 CFR 5.603. Personal property that is not categorized as necessary are considered non-necessary. Non-necessary personal property is included in the calculation of net family assets. Examples of non-necessary personal property include recreational vehicles that are not used for daily driving, such as ATVs. This can also include campers and motorhomes. Bank accounts or other financial investments. All expensive jewelry that does not hold a religious and/or cultural value or family significance. And collections such as stamps and coins. Table F1 within the HOTMA notice provides examples of what is considered necessary and non-necessary personal property. This is not an exhaustive list, and when determining whether an asset is necessary or non-necessary is actually a highly fact-specific determination. The owner needs to gather enough facts to properly classify an asset as necessary or non-necessary. I've created several resources to help further the understanding of HOTMA. These are available on the HUD Exchange. The next several slides were developed using the Assets, Asset Exclusions, and Limitation on Assets resource page. Personal property exclusions include all necessary personal property. Necessary personal property includes medical devices and vehicles used for commuting. It also excludes non-necessary personal property when the combined value does not exceed $50,000. As a reminder, non-necessary personal property can also include baseball cards, boats, and coin collections. Savings account exclusions include retirement accounts that are recognized by the IRS, which include IRAs, employer retirement plans, and retirement plans for self-employed individuals. Value of certain education and disability accounts as authorized by federal, state, or local government, which include the Coverdell and 529 education savings accounts and ABLE accounts. The value of baby bond accounts are excluded. Family self-sufficiency accounts are also excluded, as the family does not have access to the account while in the program. Let's look at an example of calculating net family assets while applying the HOTMA guidelines. Remember, this is a change from how you historically calculated assets. A household has a 401k retirement account with a balance of $157,000. The prior quarter yield was 5% or $7,500. Distributions made to the household were $12,000. Under HOTMA, the balance of $157,000 is excluded in the calculation of assets, and the $7,500 is excluded in the calculation of income from assets. The $12,000 distribution is considered income. As you apply HOTMA in your work, you'll want to pay close attention to the type of asset and determine if it should be included or excluded. Real property exclusions include real property when a household does not have the legal authority to sell, any interest in Indian trust land where a household has interest in land held in the trust by Bureau of Indian Affairs, equity in a manufactured home where the family receives assistance under 24 CFR Part 982. This includes housing choice voucher manufactured home space rental participants, equity in property where the household received assistance under 24 CFR Part 982, which includes housing choice voucher homeownership participants for the purchase of real property other than manufactured homes. Cash exclusions include all money received in a legal settlement, including civil action or a settlement based on a claim of malpractice, negligence, breach of duty that resulted in a disability. An example is a drunk driver who injured a household member who is now disabled. The money received under this lawsuit is excluded. New to HOTMA is the exclusion of all tax refunds or refundable tax credits for a period of 12 months from when the household receives the refund. Trust fund exclusions. This includes trust funds that are not revocable by or under the control of the household, including irrevocable trust funds and trust funds that are revocable once a minor child reaches the age of 21. As long as the trust meets this definition, it is not an asset of the household. In continuing with trust funds exclusions, we're going to take a look at Table F2. Table F2 from the HOTMA notice is a tool to assist owners in determining whether a trust should be included in the net family assets and if earned interest or distributions are considered income to the household. For this training, Table F2 has been split into 3 sections. This first section, we're going to discuss revocable trust. When the grantor of the revocable trust is not part of the household and the household is not in control of the trust is not included in net family assets, any interest earned is not part of the household's income, distributions of principal are not part of the household income, interest distributions would be considered part of the household's income, unless these distributions were used to pay for the health and medical expenses of a minor. With this situation, only count the actual interest that was distributed to the household, even if this is less than the amount of the actual interest earned on the trust fund. Let's talk about the next section on Table F2. This section is going to continue discussing revocable trust. Revocable trust when the grantor is part of the household or a household member has control of the trust. Then, this trust is considered part of net family assets. The actual interest earned is part of the household's income. However, distributions of the principal are not included in income, and the distributions of interest earned are not income. The next section of Table F2 continues with irrevocable trust. Irrevocable trusts are typically special needs trusts. These are not part of the household's net family assets. Actual interest earned is not part of the income. Distributions of trust principal are not included in the household's income. However, distributions of interest earned on the trust principal are included as income, unless, of course, the distributions are used to pay for the health and medical expenses of a minor. Another big change brought by HOTMA is the treatment of net family assets. When a household's assets are at or below $50,000 as adjusted for inflation, the household can self-certify the amount of their assets. While self-certification is allowed, the anticipated amount of income from assets must be disclosed and counted as income. Management can decide to verify assets if there are other facts or circumstances that create a conflict. However, third-party verification of asset is only required when the household's net family assets exceed $50,000 as adjusted for inflation. Look at the treatment of actual income under HOTMA. Actual income is always included in the household's income regardless of the total value of net family assets, even if that assets are less than $50,000, whether the asset is included in net family assets, unless the income is specifically excluded under HOTMA. Remember, actual income can include interest, dividends, and other income earned as an asset. One thing to look at under HOTMA is that checking and savings accounts now always earn interest even if the interest is zero. Let's take a look at calculating income from assets when assets do not exceed $50,000. In this example, we'll calculate income from an asset that is excluded. Eugene Park has the following assets: a checking account with a balance of $3,500 and earns 0% annual interest. They also have a savings account with a balance of $10,000 but expects to earn $300 annually. The total value of assets is $13,500. The total net family assets is 0, and the actual income is $300. Since the total of non-necessary personal property is not equal to or over $50,000 as adjusted for inflation, these assets are excluded from the total net family assets. However, the $300 actual income disclosed by the household will be included in the household's income calculation. Under HOTMA, the calculation of imputed income from assets changed. Calculating imputed income is completed when 3 conditions are met. The value of net family assets exceeds the threshold as adjusted annually. This threshold is $50,000 for 2024 and has been adjusted to $51,600 for 2025. And the specific asset is included in net family assets, and actual asset income cannot be calculated for the assets. Remember, unlike pre-HOTMA, you will not impute income if an asset earns income or an asset is excluded from net family assets. Chart F1 of the HOTMA notice provides a visual to help further the understanding of determining income from assets. First, determine if the net family assets exceed $50,000. If no, annual income includes only actual income on assets. Households are allowed to self-certify that their net family assets are below $50,000, and you will not impute income on any assets. Let's review the calculation of income from assets when net family assets do not exceed $50,000. The Cross family has a checking account valued at $5,000 and earns 0.07% interest. They also have a boat used for recreational purposes valued at $15,000. Miss Cross has an engagement ring valued at $3,000. The checking account and the recreational boat are considered non-necessary personal property. So these assets will be considered when determining the value of net family assets. The total of the non-necessary personal property is $20,000. Mrs. Krause's engagement ring is considered necessary personal property and is excluded when determining the total net family assets. Since the non-necessary personal property is below $50,000, their net family assets equals 0. And since the anticipated income from the checking can be calculated, the $3.50 of anticipated income would be included in the total annual income. Continue with chart F1 of the HOTMA notice. Let's review calculating income from assets when all assets earn an income. First, determine if the net family assets exceed $50,000. If yes, then determine if all assets earn an income. If yes, then annual income will include only the actual income from assets. While net family assets exceed $50,000, there is no need to impute as actual income can be determined from all assets. And continue with chart F1 of the HOTMA notice. Let's review calculating income from assets when not all assets earn an income. Remember, first you'll need to determine if the net family assets exceed $50,000. If yes, then you'll need to determine if all assets earn an income. If no, then annual income includes only the total of actual income that can be calculated and the imputed income for assets that income cannot be calculated for. Remember, imputed income is only required when the net family assets exceed $50,000, and not all assets' annual income can be determined. Let's review an example where the actual and imputed income from assets is necessary. The Jorgensen family owns a small piece of vacant land with a cash value of $25,000. The family also owns a savings account with a verified balance of $55,000 with an interest rate of 0%. The family's total net assets are $80,000. The passbook saving rate in effect is 0.10%. The actual income from the savings account is 0, and the imputed income from the family's property is $25. The total asset income is only $25. Remember, these assets exceeded $50,000, so the third-party verification is necessary, and checking and savings accounts that earn a 0% interest rate are considered as earning income even if the income is 0. Let's review an example where imputed income is necessary. The Conrad family owns a recreational boat with a Kelly Blue Book value of $15,000. They also own a checking account with $10,000 that earns 0% interest. a savings account with $30,000 that earns 3% interest. This makes the net family asset valued at $55,000. The passbook saving rate in effect is 0.10%. Based on this, the actual income can be determined to be $900 and the imputed income is $15. This gives the household a combined total of income from assets of $915. This amount must be included when calculating their annual income. Let's discuss the inflationary annual adjustments as identified by HUD and how it impacts assets. Remember, for assets, this threshold is $50,000 for 2024 and $51,600 for 2025. HUD will annually publish inflationary adjustments for 8 inflation-adjusted items. 3 of these will impact the calculation of assets. The first is the value of when you'll need to impute income on assets that do not earn or income cannot be determined for. The second is the value of which non-necessary personal property will be excluded from net family assets. And the third is the value of net family assets that would allow the household to self-certify their assets. In addition to these 3 items, HUD will also annually update the passbook rate and publish this no later than September 1st with an effective date of January 1st. For 2024, it was 0.40%, and for 2025, it is 0.45%. These updates will be available on the HUD Exchange users website. Remember, it is management's responsibility for reviewing and implementing the latest HUD inflationary adjustments annually. Now that we have covered the asset changes under HOTMA, let's discuss a recommended approach on applying these changes. When reviewing assets, you might want to apply a 3-step approach. First, review the assets and determine which, if any, are considered necessary personal property. If the household has necessary personal property, then these are excluded from the calculation of net family assets. Remember, checking and saving accounts are always non-necessary personal property. Second, you'll want to determine the value of non-necessary personal property to see if they exceed the threshold. If yes, then all assets are required to be verified using third party. Any assets that do not earn an income nor income can be determined for will have an imputed income calculated for using the current passbook rate. Remember, if an asset has income, do not impute income. This was a change with HOTMA. All assets will need to be reported, and all actual and imputed income on assets is included in the calculation of the household's income. If no, and the household's assets do not exceed the threshold, then all non-necessary personal property is excluded and listed as 0. You will only count the actual income earned on assets. In step 3, you'll want to review the real property to determine if the value plus the non-necessary personal property exceed the threshold. If it does, then the household's assets are over $50,000 and you'll need to proceed with a third-party verification and using imputed income. Remember, all actual income received on real property is always included as an income from asset, regardless of the value of net family assets.
Hi, this is Sarah Watson, and I'm going to be going over some changes to our verification requirements. As you've heard throughout this presentation, implementing HOTMA will mean significant changes. It'll mean letting go of some old habits and adopting a new way of thinking when it comes to verifying income. Fortunately, the fundamental objective remains the same. We still need to verify all income and assets and confirm that the household qualifies for the tax credit program. However, we understand that many properties may have layered funding, meaning that a household may not only have to qualify for the tax credit program, but they might also need to simultaneously qualify for programs like Project-Based Section 8 or Rural Development. With that in mind, the Commission is adopting a policy which aims to create consistency among the different housing programs regarding how income and assets are counted and verified, which will hopefully reduce the burden on those who are trying to access the housing assistance. Here, you can see the Commission's verification hierarchy chart, which describes various verification methods and ranks them in order of acceptability. The Commission is adopting a modified version of HOTMA's income and asset verification hierarchy. If you've had the chance to review HUD's Notice H 2023-10, then this might look familiar to you. This chart has been adapted from Table J2 found in Attachment J of the HUD Notice. Please note, we have omitted Level 6 from our chart because Level 6 pertains to EIV. And remember, federal regulations prohibit the use of EIV reports to verify income for the tax credit program. Let's take a closer look at the 5 levels of the verification hierarchy chart. Level 5 is ranked as the highest, meaning it's the most preferred method of verification. Whenever possible, you should always start here for income and asset verification. Upfront verifications include reports from sources like the Work Number for Everyone, the Benefit Verification System through WSHFC, and other income and/or asset verification websites that can be accessed by management. Of course, remember that this excludes EIV, which cannot be used to verify income for the tax credit program. As a best practice, the Commission strongly encourages management companies to prioritize the use of these upfront verifications from point-in-time electronic data sources. We understand that some of these verification systems cost money to use. However, to avoid creating additional barriers to those who need low-income housing, the Commission urges management not to pass along these costs of the verifications to their applicants or residents. Fortunately, to verify public assistance, Washington State's DSHS has a great system called the Benefit Verification System, or BVS, which is free. You just need to create an account and you can run reports. For additional information, please see the website below. If management companies are not using upfront electronic data sources to verify income and assets, so that would be your level 5 verifications, then they must pursue verification in the order outlined in the verification hierarchy chart. This means that level 4 would be the next highest form of verification that should be pursued. So let's take a closer look at level 4. Level 4 refers to written third-party verifications provided by the source. These are documents that are provided by the household, meaning that they're supplied by either your applicants or your residents. Some examples would be paycheck stubs to verify employment. Please note that we would need a minimum of 2 current and consecutive pay stubs. It also include benefit statements to verify things like Social Security and/or public assistance. To verify seasonal or self-employment, we would need a copy of a signed income tax return. In most cases, these documents should not be older than 120 days prior to the effective date of the certification. That means that once a verification ages past 120 days, it's considered invalid and a new verification must be obtained. The exception to the 120-day rule would be for fixed income sources, such as Social Security benefits. In these cases, a statement dated within the most current benefit year would be acceptable verification. This would also apply to tax returns. We would just need a copy of the signed tax return for the most recent filing year. On to level 3, we're going to talk about third-party verification. An example would be having an employer complete the traditional WSHFC employment verification form. Now, if you've been in the industry for a while, this might be a bit of a record scratch moment for you. I know it definitely was for me. I've been in the tax credit world for 20 years now, and as long as I can remember, third-party verifications were always the standard when it came to employment verifications. And now these should only be used if you're unable to obtain upfront verifications or pay stubs. If this feels a little counterintuitive to you, I encourage you to take a moment to recalibrate and try to remember the main objectives of HOTMA. We're trying to streamline the verification process to be more consistent across all of the housing programs, and we're also trying to reduce the burden on our applicants and residents. Level 2 refers to verbal third-party verifications. So it's similar to level 3, just verbal. You can utilize the Commission's clarification by telephone form to verify and/or clarify information. Again, you need to work down the verification hierarchy chart in order from the highest to lowest. Lower level verifications should only be used if level 5 and level 4 verifications are not available. If you end up verifying income or assets via level 3, 2, or 1 methods, you'll need to include an explanation in the file to document why the higher forms of verification weren't used. So you can't just skip to the lower level verifications. There needs to be a legitimate and documented reason. Level 1 verifications refer to self-certifications from the applicant or resident. Self-certification statements are ranked lowest in terms of acceptability and should only be used as a last resort when all other levels were unavailable, except in cases of verifying zero income and/or net family assets less than $50,000. These are the only 2 instances in which you could skip straight to level 1. It's no longer required to notarize any form of verification. This includes level 1 self-certifications. However, we strongly recommend that self-certification statements include language to ensure that the certifier understands the consequences of knowingly providing false information. If a household receives fluctuating income, or if there's no reliable verification of recurring income, then it would be acceptable to use a copy of a filed tax return to estimate their anticipated income. Now that we've wrapped up the changes related to verifications, let's move on to changes in how income should be calculated. When calculating employment income, if the verification shows variable payment amounts, meaning there's not a set payment amount that's received every pay period, then management should calculate based on average income or average wages. For example, 2 consecutive pay stubs show that the resident is paid weekly. Pay stub number 1 shows gross earnings of $975. Pay stub number 2 shows gross earnings of $1,200. These amounts are not the same, indicating that the income is variable from pay period to pay period. So to calculate the average, you'll need to take $975 plus $1,200, which gives us $2,175, which you would then divide by the number of pay periods, in this case 2, which gives us an average of $1,087.50 per pay period. We know that the resident is paid weekly, so then you would need to multiply the pay period average by 52 weeks to give you an annual amount of $56,550. If you were to calculate employment income based on a level 5 verification, such as a work number report, you would calculate the average income based on the earnings for the current year. I know that these reports can sometimes include a lot of information, sometimes going back several years if they've worked there for a while. Don't include more than 12 months of income data when calculating wages. We only want you to include information for the current year when calculating your average. So now I'm going to hit you with another big change. With the implementation of HOTMA, the Commission will no longer require year-to-date calculations when determining annual wage income. This means that you no longer need to calculate employment income 2 ways and then take the highest of your income calculations. Instead, any variations in wage amounts should be calculated based on the average income method shown in the example above. Continuing on with income calculation, let's go over pay increases. If a resident discloses on their REA that they expect to receive a pay increase, or if the verification clearly indicates an imminent raise, this must be factored into the annual wage calculation. Management is not required to follow up on potential increases if there's no indication of such on the REA or the income verification. So, if the verification does not show an anticipated increase, it is no longer necessary to call the employer to ask whether or not a pay increase is expected. If tip income is shown on the wage verification, it should be projected for the next 12 months. Conversely, if income is not explicitly indicated on the verification, you don't need to add any tip income to your calculations. This is a big change from how we've done things in the past. Moving forward, you no longer need to add a default amount of 20% income for applicants or residents working in service positions. Now I'd like to introduce a couple changes that are not directly related to HOTMA, in the sense that you won't find them referenced in the HUD notice, but the intent behind these policy changes aligns with the overall goals of HOTMA. Effective October 24th of this year, so this has already taken effect, VA service-connected disability benefits are to be excluded from household income for individuals on HUD BASH programs. So again, this change has already taken effect based on the Revenue Procedure 2024-38, which was recently published by the IRS. When omitting this kind of income, please be sure to document the file with a copy of the BASH voucher or other documentation from the VA, the Veterans Administration, showing that the resident is on the HUD BASH program. Beginning January 1st of 2025, the Commission is revising its annual recertification policy. This is only for 100% tax credit properties. So any project that has market units, if you have a mixed income property, the following policy does not apply to you. This is only for 100% tax credit properties. But beginning January 1st, third-party certifications will only be required at initial qualification, so at move-in. Beyond that, self-certifications of income can be accepted for all recertifications. So you no longer need to complete a full certification for that first annual recert. You can go ahead and proceed with self-certs right out the gate. So the only certification that's going to require third-party certifications and verifications will be the initial move-in. Okay, we've made it to the end of our presentation. I'll wrap things up by going over what you can expect in the coming weeks as we roll out all of these changes. First, I'd like to reiterate that we here at the Commission are still learning HOTMA and adjusting our policies and procedures. We're doing our best to ensure that our policies are in line with the published guidance pertaining to HOTMA, as well as its underlying goals. That said, there may be additional tweaks or changes in the future. If you haven't done so already, I strongly encourage you to sign up for e-news, which is our electronic newsletter, to make sure that you can stay informed. You can sign up for e-news by visiting the Asset Management and Compliance page of our website. The Commission will be implementing HOTMA for certifications started on or after January 1st of 2025. So if you've already started a certification that's effective January or later, don't panic. The file doesn't need to be redone. The Commission will be publishing a smart sheet for you to submit all of your HOTMA related questions. Again, all HOTMA questions should be submitted via this smart sheet. That's going to help us make sure that everything stays organized and we can get the answers out as quickly as possible. So please keep an eye on your email, as the link to the smart sheet will be sent out via e-news. We'll be reviewing and answering all questions in our FAQs, which will be updated on an ongoing basis. Updates to our tax credit compliance manual, as well as our FAQs, will be posted on our website throughout November and early December. Thank you for taking the time to watch this presentation. I hope that you found it helpful.